Hello everyone and welcome to your Glassnode video report for week 46. I'm your host Checkmate and I'm recording this on the 16th of November 2021. So this week we really explore the concept of the chain or an inflection point in the bull market. What we generally see in bulls is this two-phased approach where the first part of the bull market is relatively quiet, it comes out of the bear, it's following a period of heavy accumulation, and generally we see the smart money continuing to buy and pushing the price up before much of the hype starts to arrive. Now at some point that transitions into a far more euphoric, far more fast-paced, and generally a more media-driven type later stage of that cycle. And generally what we see is that those longer-term holders, the smart money, they start their accumulation early in the bull and then they start distributing as we transition into phase two. And there's a number of metrics this week that we're going to look at that really are starting to describe that transition, that inflection point between the early bull and moving into really the second part of this bull. And really this is quite interesting because we've actually seen this play out twice now. We've seen it through the first part of 2020 and then into 2021, the first half was very much that phase one into phase two transition. And when we had the correction through May and June, July, and we've more or less restarted that cycle. We've seen this phase one of this heavy accumulation through September and August, and now we're moving into this phase where we're getting more of that spending kicking in. So we'll explore a number of concepts like coin days destroyed and lifespan. We'll look at things like realized profit and loss as an estimate of the amount of demand that's coming in. So that's really describing this transition. And then the second half of the video, we're going to jump in and look at some of the more cycle tops, some of these metrics that we have available in our toolkit to really navigate what could be the next blow off top. So looking at what are the types of behaviors, the spending patterns, and the historical mean reversion models that we have in our tool belt to really navigate what cycle tops may look like. So let's jump into our dashboard and we'll get started. So this week we pushed up to a new all-time high, just shy of $69,000 for Bitcoin. We're starting to get a little bit of consolidation and finding and acclimatizing ourselves to the altitude up here at 60,000. And really what we're seeing is a very, very strong week. It'll be interesting to see whether we do get some downside to kind of just put in that bull flag, start to really cool down the market, pull some of that heat out before we do get a leg up, or if the market does in fact just want to power on and push forward. So we'll look at a few of these different dynamics. What could be some of the inputs? What would suggest that there's a higher likelihood of a sell-off? What's the higher likelihood that we continue to push forward? And ultimately a lot of this comes down to the spending patterns and that supply and demand balance. So first we're going to start off with is the concept of lifespan. So we've covered this in a number of videos, but I'll just highlight what a coin day is. So for every coin in the supply, so one BTC will accumulate one coin day per day that it's in existence. Now, if it's dormant for say 3 days, that coin has accumulated 3 coin days. If it was half a BTC, will have accumulated 1.5 coin days. Now, when a coin is spent, we consider that lifespan, how much accumulated dormancy or time, how much accumulated coin days are destroyed when it's spent. We consider it reset back to zero, and then it starts reaccumulating again. So using that concept, very, very old coins are generally held by people who've seen lots of volatility, they've seen the market bounce around, they're quite experienced, they understand how Bitcoin moves. So when we look at a metric like coin days destroyed, what we're looking at is the absolute value, how many of those coin days were destroyed in a particular period. Now I've got a 30-day moving average applied here because it just smooths out. We're looking for the big picture trend here. We're not so fussed about the day-to-day. We're looking at the big picture. What is the overall movement of the market? Now, if we look back here in the pre-bull phase, note how it tended to trade somewhere between 5 million and 10 million coin days per day. It's relatively flat. This is kind of a pre-bull baseline. We generally see these flat patterns when we have an accumulation period. So when we have very few coin days being destroyed, it generally means that the older coins are dormant, they're staying unspent in cold storage. There's a higher probability that some of those older hands, those people who are experienced, are actually buying younger coins off the market and sending them to cold storage for sale at a later point. So accumulation tends to form these kind of long, lengthy bottoms. And then as we move into October and November of 2020, we started to get this phase one of the bull. So this is phase one of the bull. This is the transition into phase two. Now, the transition to phase two normally comes around the next all-time high. So as we pulled up here in December towards the 20,000 all-time high from last cycle, we can see that the spending had really ramped up. Some of those older coins were coming back onto the market, and this creates an uptrend in our coin days destroyed metric. Now we can actually see this in a system metric called binary coin days destroyed. So it uses the same concept. We can clearly see that this is kind of a stable baseline, and this is an acceleration where we get a lot more coin day destruction. So if we took a long-term average, what's an average amount of coin days that are destroyed on any particular day? What's the long-term average? Now, if we're destroying more than average, it's suggesting that it's an above average day, there's more older coins on the move, and therefore binary coin days destroyed will return a 1. If it's less than the average, it will return a 0. Now I've applied a 7-day moving average to that. So normally this will look like a barcode, and you'll see bunched up plots when you've got higher amounts of spending, and when you've got less spending, you'll get more of these gaps. But by applying a moving average, we can start to see these similar trends, and you can actually see where it's sustained these large blocks where you get this significant amount of coin day destruction. This is aligning with this period through from December all the way through to February, where we had a great deal of coin day destruction. Now on both of these metrics, we can see that through April, May, June, July, we really had a significant softening out. This really started to slow down. The coin day destruction dropped even below. You can note down here at the very, very bottom down here at 29,000, we were actually down here below 5 million coin days per day, and it was actually below the pre-bull. So this is really telling us that accumulation was going on. We're seeing more and more of these older coins staying dormant. Generally what that means is it's an accumulation period. You're seeing more coin days actually being staying dormant. That means that there's fewer being destroyed. Those older hands are more likely to be buying at that point in time. And we can see this significant gap that opened up in our binary coin days destroyed. This persisted all the way through July, all the way through to October. Now, of late, we've started to see a bit of a pickup, right? We've seen more of this spending behavior come back in. Note that it actually looks quite similar to what we had back here in, around the same time, this time last year. This is kind of that transition phase. We're starting to move out of this heavy accumulation period where there's very few coin days being destroyed. We're starting to get that early spending. As I mentioned, it's normally as we push towards new all-time highs. And then during a full-scale bull where you have the demand flowing in, people can liquidate and sell those coins, and there's enough demand to absorb the supply. And this is why you get these large uptrends in coin days destroyed and sustained periods of high binary coin days destroyed. So the way to interpret this is it looks like we're starting to get to that transition. It's starting to move. It's not necessarily the end of the bull market. It's certainly getting to that point where we're transitioning out of the smart money accumulation, and it's moving into more of that strategic. And as we go further along this market, there's going to be more distribution. This is typically what we see in these market cycles. So it's kind of interesting to watch this transition play out. And what we can also then look at is these are two very, very big picture metrics. We have here liveliness and the realized cap. And I've actually put these in large screens so we can actually look at how they behave relative to each other, because we'll see a couple of interesting trends show up here. So liveliness is a very, very big picture. We mentioned before that every coin in the supply will accumulate 1 coin day per day. So you can think about the circulating supply is generating 18.8 million coin days every single day. Now, some of those coins are obviously spent, and that's destroying lifespan. So what liveliness does, it takes a ratio of the all-time coin day destruction to the all-time coin day creation. So the way to think about this is when we have a downtrend in liveliness, and this is a very big macro metric. When you have a downtrend, it's showing that there is more coin days being created than destroyed. There is more hodling and dormancy in the coin supply than spending. Now, the steeper the curve to the downside, the more hodling is going on. So generally, a long-term downtrend in liveliness is generally present during a bear market, but it's actually showing that there's a lot of accumulation going on. Older coins are staying dormant, young coins being taken off the market. And the exact opposite is true. When we have this steep uptrend in the liveliness metric, it's showing that lots and lots of coin days are being destroyed. There is more coin day destruction than creation, and the steeper the curve, the more coin days are being destroyed. Note that from November all the way through to February, it was a very steep curve. It flattened out through to May, and then it started to actually reverse. This is an inflection point from a bullish distribution into a more bearish trend, but that also describes accumulation. And this is the same as the pattern here. This is the very steep curve. Then we get the softening out of it. So this period through from January all the way through to July was this softening out. And then we moved into a deep accumulation period from July through to October, which is more or less what we've seen in this downtrend in liveliness. Now, note that it started not quite to a full scale. We're not seeing a full scale distribution as we saw back here. It's starting to curl around. And this is why I'm describing that inflection point. Now, sure, this could perhaps go back into some kind of accumulation period and keep trending down. But what we're more likely to see is that this will continue to trend up as price shows strength, as the market absorbs more coins. We're going to see more of these older coins come back into circulation, taking profits, as is typical of a bullish market. Now down the bottom here we have the realized cap. So whereas Liveliness is looking at the lifespan, the overall macro trend of coin day destruction, the realized cap is looking more at a dollar value. So it looks at every single coin in the supply and it values them at the time when they were last spent. So if a coin was withdrawn at $10,000, it is essentially stored at that $10,000 level until it is spent again. Now, in a very similar way, we tend to have this very flat realized cap during bear markets because most of the coins that are being transacted, if you look at a bear market on a big picture scale, even the 2018 through to 2020, we traded between 10,000 and 3,000 for a number of years. So really, it's this sideways price action. Most of the coins that are on the move are kind of at a similar price, so realized cap trades sideways. As we move into the bull market, however, and prices start to push to new all-time highs, we get this acceleration. Alongside the uptrend in liveliness, more coin days being destroyed, older coins are more likely to be coming from a cheaper price, and that revalues. Those $10,000 coins, $3,000 coins are revalued to $30,000, to $40,000, to $50,000. So we get this very steep uptrend in the realized cap. And then we start to get this plateau, right? So through the bear market that we had through May, June, July, we had this sideways to slightly down. It's showing that people who bought the top, they bought 60,000 and they're selling down at 20,000 or 29,000. They're liquidating and there's flushing money out of the system. And you can see that we've also started to reverse back into an uptrend. Now, what I actually want to highlight, note how liveliness is in a downtrend as realized cap is sideways. We got a similar pattern where we had this kind of two-phase steep uptrend and then a shallow one, steep uptrend, and then it started to shallow out. Note, however, at the moment that liveliness is still kind of down to slightly ticking up. It's still relatively soft. There's not many coin days being destroyed. On the other hand, realized cap is rallying quite substantially. It's up to a new all-time high of 450 billion. What that's actually telling us, we have coins being revalued higher, but we have not quite so many coin days being destroyed. That tells me that most of the coins being spent at the moment are actually from within this recent market cycle. Most of the coins that are on the move were not purchased back here at $6,000, $5,000. Some of them, of course, will be, but most of them are actually being revalued from relatively young, a couple of months old. That's why we're getting this kind of soft uptrend in our liveliness, but a very steep uptrend in our realized cap. It's showing that coins are being revalued higher, but they're not necessarily very old. We're talking a couple of months. So that's just an interesting kind of observation between these two very, very large macro metrics. So lastly on this, before we jump into our cycle topping metrics, I just want to highlight two metrics that I think don't quite get enough attention that I quite like to use, and that's our realized profit and realized loss. So this is looking at the dollar value, how many coins were revalued higher and how many were revalued lower. Now, what we're looking at here, you can see this reasonable uptrend, and we're talking at the moment between about 1.5 and $2.1 billion when you sum realized profit and realized loss together. We're talking about $2 billion to $1.5 billion per day is being realized. So these are coins that are moving, that last moved at a higher or a lower cost basis, and they're being spent on chain. We assume that those coins are sold, and this gives us some indication of demand. So what we've seen over the last couple of months is rising realized profits. That means that more people are spending coins at a profit, likely taking money out of the market, but the market has rallied upwards or sideways over the last couple of weeks. And that's showing that the market is actually able to absorb that amount of sell side. So at the moment, we're talking about between 1.5 and around $2.1 billion per day is flowing in to absorb those coins, because for every seller, there's a buyer. Now, of course, if we start to get some kind of downside price action, that starts to tell us that there's more supply than demand. But I also suspect if we are in a strong bull market, we will probably see realized profits declining as we see a pullback, because that generally means people are not willing to sell at cheaper prices. They're actually going to wait for higher prices. Now, of course, if people continue to sell as price goes down, that's a more bearish signal. If, on the other hand, we start to see this slowing down of our realized profit, even a slowing down of our realized loss, although a capitulation event is generally a good thing to see because it shows that people who bought the top are getting flushed out. But generally what you want to see is less people spending as price pulls back. And that's generally signaling they're more likely to be stepping in and actually buying the dip than selling at cheaper prices. So now what we're going to do is jump across to Workbench and Studio and look at a couple of these cycle top metrics and just transition to how do we navigate what could be the next bull market top. So we've recently launched, we're here in Workbench, and we've recently launched a number of presets. So these are some of these metrics that are built by the community, some that have been around in the Onchain community for some time, and we've launched these as presets for advanced and professional members. So you can see most of these metrics and actually see some of the work that's being done by the community, all with various descriptions available. So the first one we're going to look at is the top price model, which was made by Willy Woo. And what we look at here with the top price model is we have the average cap. So this blue line down the bottom here is basically the average price of Bitcoin through its entire history. So if you took an average right from the first price point all the way through to our current price, the average price is currently sitting at about $6,130. Now what Willy Woo found is when you apply a factor of about 35 to that metric, it actually lifts up and tends to correlate with reasonable accuracy to the top of the model, right? To these cycle tops. So it's more of an empirical curve fitting type model. It's one of these ones that has shown to have some relevance through various market cycles. And where we're currently sitting at the moment is about $214,000, which I'm sure most of us wouldn't be too upset with. So this is just one of these very interesting, very simple models that's just taking a curve fitting exercise, adding a multiple of 35 to our average price and giving us some kind of a top model. Now, what we also have is the Mayer multiple. So this is actually one of my favorite metrics, and I like it because it's so simple. So the 200-day moving average in orange, generally it's kind of this long-term mean. The reason that the 200-day moving average is quite important is because during bear markets, it tends to act as some kind of resistance. During bull markets, it tends to act as some kind of support, and it's also one of these well-known, well-understood, and well-observed trading indicators. Lots and lots of investors are looking at the 200-day moving average. When price is above it, they generally have a bullish bias. When price is below, it generally has a bearish bias. So over the very long term, it's kind of this mean, this typical average price, 200 days, something that everybody is looking at. Now, what the Mayer multiple does is it takes the simple ratio between price and the 200-day. Now, what we're really looking for here is when is price much, much higher than the 200-day? It's like an elastic band being stretched too far away from the mean and it wants to spring back. And likewise to the downside, when it's too far below the 200-day, it becomes improbable that it's going to keep falling and it's more likely to mean revert back towards it. So what we can essentially identify is what do we call an undervalued Mayer multiple? What's a distance that's too far to the downside or too far to the upside? So we have up here oscillator values of 0.8 and 2.4, which describe undervalued and overvalued. You'd think of this as about 0.8 means it's 20% below the Mayer multiple. The 2.4 means it's 2.4 times larger than the 200-day moving average. And we can then establish pricing bands. So multiply the 200-day moving average by 2.4 or by 0.8. So if we actually zoom into let's go to a 2-year basis so we can see where we're currently at, you can see that through the January and then into March period, we actually broke above that 2.4 by some magnitude, and that technically provided some form of a topping signal, right? We had 1, 2, 3 touches before we broke back down to the undervalued zone. And as you can see, we're somewhere around halfway, right? We haven't quite tracked back up here to the 2.4. And if we did track up to 2.4, that would give a Mayer multiple price about $110,000, which again, I'm sure many of us would be quite happy with. So it kind of shows that if we consider the Mayer multiple being this long-term oscillator, you can see back here in March 2020, it also fell below that level. It provides this kind of just general slingshot where it's bouncing between overvalued down to undervalued, and we're currently halfway through the journey, if this cycle does tend to repeat, towards getting back up to the top. And remember that as the 200-day moving average moves around, because it's a non-stationary metric, then these bands will also adjust accordingly. So the Mayer multiple is a really cool tool that really uses some statistics and just kind of maps out what is an unlikely event to the upside or to the downside. Now, on a very similar metric, we have the MVRV Z-Score. So it uses very similar concepts to the Mayer multiple. However, instead of measuring price relative to the 200-day moving average, it measures relative to the realized price. And the realized price is kind of the on-chain cost basis. So where the 200 days kind of this long-term moving average, this is basically mapping how in profit is the market or how underwater is the market. So, and what it then does is use a Z-score, which is a normalization method. It basically maps out how many standard deviations or how statistically far away from that long-term average in the realized price are we currently. And you can see that in all of these instances, we tend to have cycle tops that break well and truly above a value of 8. If we look at our 2017 market, we pushed up towards 6 on 2 occasions, 3 occasions, and then we finally had our blow-off top that blew well above a value of 10. So it certainly provides, and you can see here again in 2021, we also pulled up back into this, this red zone, this 6, 7, 8 type level. Now, there's no explicit magnitude that's going to signal when we're actually overheated. The markets can change and be dynamic, but what we generally look for is confluence. Do we have the Mayer multiple and the MVRV telling us a similar story? Are we in the overheated zone? In this instance, back here in 2021, we know the Mayer multiple was and the MVRV was as well. So that's starting to signal that there's potentially a point where we can de-risk or at least just assess what kind of probabilities there are that we're getting into that overheated zone. And very similar to the Mayer multiple, after that sell-off in May, you can see that we've more or less recharged or flushed out much of that speculation, and we're now actually quite some distance below. We're, again, roughly around halfway along this journey back in towards the red zone. So again, the markets are dynamic, it's always changing, but this certainly provides a metric based on where everybody's cost basis is on chain. What is the overall behavior expected? Now, moving more into a kind of an on-chain native type metric, the realized HODL ratio, which we often abbreviate to RHODL ratio, is a really fascinating metric that was originally developed by Philip Swift. Now, what this does, at cycle bottoms, we generally see that old hands, people who understand the market, are willing to hold for a long time, they generally hold the most supply. And we map this by looking at the 1-year-old coin bands. Now, on the converse, when more new speculators, new weak hands, people who are only just entering because the news was hyping up Bitcoin, they generally get characterized by the 1-week-old coin bands. So what the RHODL ratio does is it just takes the ratio between how many coins are young and how many coins are old. And at the very bottom of these market cycles, this is saying that the maximum number of old hands have coins. So we have flushed out all the speculators and only the smart money remain. Now, as that smart money start to distribute, as we mentioned previously, coin days are destroyed, coins are put back into the market, liquid circulation starts to increase, and then eventually the maximum number of new investors who've only been here for 2 weeks are holding most of the coin supply, and that generally signals these market tops. So it's trying to map out the ratio between new investors and old investors. At the bottom of markets, you want to see the most old investors, people who understand and they're here for the long term. And at the cycle top, you're going to see the exact opposite. Mostly speculators, mostly tourists, people who've come in and just bought their first Bitcoin at the very top, generally signals these market tops. And what was really nice about this metric, and many other metrics tend to pick up this 2013 double pump, both of them being overvalued, the RHODL ratio is actually one of the few that didn't do that, which is quite remarkable. One of the few that, and you can see actually, we consolidated in this particular zone, which is actually not too dissimilar to where we are. So there are actually some similarities between 2013, particularly between the balance of new investors and old investors, which is quite an interesting metric. And lastly, we're going to look at the reserve risk. Now, the reserve risk is a base metric that we have in Glassnode Studio. This is actually a preset in Workbench. And the reason that we have 2 versions, this actually describes all of the pieces. It's actually quite a complex metric, but very simple at the same time. There's lots of steps, but it bakes a lot in. So very simply, we have price here in gray in the background, and think of price as the incentive to sell, right? The higher price goes, the more likely somebody is to sell. The orange squiggly line that we see is the value of coin days destroyed. So we mentioned that more coin days are destroyed during bull markets, less during bears. And the red line in the middle is the median value of that. So I'm going to turn off that the value of coin days destroyed, because what we really care about here, during cycle tops, the incentive to sell in black is being matched by the amount of spending. More people are selling into that market strength, and we get this closing in. See how the red line and the black line start to close in on each other? Same as 2017, they start to match in. That's showing that the incentive to sell is being matched by the amount of sell side. Now, conversely, during a bear, note how they open up. We get this large divergence between the amount of spending, which is getting less. There's less spending going on, more accumulation, even though the incentive to sell is much higher. This is showing hodling behavior. People are sacrificing the opportunity cost to take their money out today because they believe that prices are going to go higher. We saw this again through 2018 through to 2020. We saw the closing up in 2021, and then we saw a large gap opening up during the recent market. Now, what we can then do is calculate the HODL bank. The HODL bank looks at how much of that opportunity cost, the difference between the sell side and the incentive to sell, and this will trend higher when we have more hodling, and when we have massive sell side, it will slow down. So, right, when we have more of this sell side, it will start to plateau, and when we have more hodling, it will start to trend higher. So what that's essentially doing is it's kind of baking in how much opportunity cost a hodler's not realizing when they make a conscious decision, I'm not selling today. It's mapping out the cumulative amount of hodl that has been going on. And this is then when we can establish our reserve risk metric. So reserve risk takes a ratio between price and the HODL bank. And you can see actually that during the accumulation phase, it spends, this is actually a good definition for where we have the first phase of the bull, where we exist down here below this green line. And then note how it accelerates very, very quickly into the cycle top. This is largely because we get this closing in. You can see the spending matches the incentive to sell, and it rips up into the final blow off top. You can see that the vast majority of 2020, this pre-bull early phase, was actually located well and truly in the accumulation zone. And then we had a very, very swift rally upwards during that first half one of 2021. Now, note that we didn't quite get all the way back down to the accumulation zone, but it certainly pulled back quite substantially. Reserve risk is probably about 30% of the way up towards the top. But unlike Mayer multiple and MVRV, reserve risk accelerates in towards the end. So it's one of these metrics that's quite responsive to the upside. When more selling pressure occurs, more coin days are destroyed, this metric will start to really power on towards the upside. Now, we have quite a detailed explanation of this both in the description, but also in Glassnode Academy, which I'll leave a link in the show notes. But that essentially closes out this session. Hopefully it was useful looking at these various metrics and navigating the cycle tops. There's no exact metric that's going to call it perfectly. What we generally want to look for is confluence. Do we have lots of coin days being destroyed? Are lots of coins being distributed onto the market? And are many of our cycle metrics all starting to point that maybe it's getting overheated? You want to look for a large pattern across a number of metrics and use that to really map out your risk profile rather than looking for a single metric that tells you the single source of truth. Certainly keeping track of a number of these things and just understanding how they work is going to generally give you more of a toolbox to navigate cycle tops. So thanks for tuning in. Hopefully you found this useful. Let me know what you thought in the comments, and I look forward to seeing you next week. Cheers.